Hello and welcome to yet another instalment of our Nucleus Wealth Insights series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. We also have David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, founder of the internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business Financial blog. Finally, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, please check out our people section at www.nucleuswealth.com. Yes, so hello and welcome to our next instalment of Nucleus Insights. And today we're looking at the emerging markets crisis and whether or not buy or sell is the appropriate move. We'll jump into our agenda. We've got, it's not too slide heavy today, but we will have the slides up available, or you can request those at webinar at nucleuswealth.com as well. Agenda for today, so we're going to look at the headline culprits of the emerging market crises over the years and also, of course, presently. Some structural issues sitting behind those said crises. We're going to be having a look at some of the previous ones and what's been, I guess, the trends that are the same and that are carrying through today, and also, I guess, some other crises as a point of view. Some danger signs to look out for, and then, of course, how that affects our everyday investment decisions here at Nucleus Wealth and the MB Fund. So with no further ado, we'll jump into it and we'll kick off with some headline culprits. We'll look at perhaps Turkey to kick us off. I'll welcome Damien, our Head of Investments, and David, our Chief Strategist. Welcome, fellas.
Hi, Tim.
Hi, Tim.
Who'd like to begin?
Oh, look, I'll jump in with some of the, I think if you read the right newspaper or grab the right headline, you can see that, this is all Trump's fault for putting a tariff on. You can see stuff, sort of the tales of what Erdogan's been doing in terms of, appointing son-in-laws to help with his monetary policy and getting rid of it, central bank independence, and you can draw all these...
In Turkey.
In Turkey, yes. Sorry, in Turkey. Yes, that's right. That's right. Trump's son-in-law is not yet in charge of the Fed. So you can draw these, the moral equivalents of, here's something that's gone wrong because of somebody who, strong personality and out there ideas, but those aren't the real cause of it. I guess there's deeper structural issues behind this, and that's what we really wanted to get into today was less about what was the trigger of it. Certainly some of those the tariffs and the back and forth between Trump and Turkey, it has certainly been the trigger, but it's the straw that's breaking the camel's back. It's not it's not the core underlying problems, which we'll get into shortly.
Okay, sure thing. So you mentioned there before with tariffs and ergonomics.
Yes.
So looking forward then, we'll jump into the first of our structural issues.
Yeah, and so just to explain the ergonomics term is, so he has been complaining a lot about the central bank raising rates and all that type of stuff, and that some of the economic theory over there is wrong, and so he's taking away some of the independence of the central bank. There's obviously a lot of things he's been doing post the coup or attempted coup a few years ago to get rid of sort of freedoms and things like that. And so you can draw these moral equivalents of saying, because he's getting rid of the freedom of the people and taking away these things, then he deserves to have a crisis. But that's, there's plenty of other dictatorships and places that have taken away freedoms of people who don't go through economic crises.
Okay.
And so it's not it needs to come back to more what are the fundamental underlying underpinnings behind it.
Okay, sure thing. So one of those being a rising US dollar, David.
That's right. And as always happens, when you get a rising US dollar, you get an emerging markets bear market. It's as predictable as the sun rising. So we've put this chart up here, which shows the fundamental driver for why that is. I'll take one step back actually. Look, the rising US dollar is to some extent the result of Trump tariffs, but the main driver is Federal Reserve tightening in the US, which, if you really wanted to pin something on Trump here, it would be his tax stimulus rather than the tariffs that are driving the dollar higher.
And when you say pinning it on him, we're basically saying he's done this. He's got a lot of stimulus, so the US is growing a lot faster than other countries.
Yeah, that's
so
right.
It's
not exactly evil, no. Although, we could devolve this conversation forever. Yeah. The tax stimulus was kind of screwed up, but anyway, it has created a boom in the US, a boomlet anyway, and so there's a rising US dollar because outside of the US, elsewhere, Europe, China, other places are slowing. So the Fed's the only one tightening with any real meaningfulness, and so the US dollar is rising as it does. Now, the direct consequence of that, or corollary of that, is that capital starts to repatriate from emerging markets as the carry trades that relied on an uplift from low US interest rates to higher interest rates in emerging markets. They all start to reverse because that spread gets erased. And so emerging market currencies start to fall as the US dollar rises, and then if they have external debts, they start to get more expensive. If they're not swapped or hedged in any way, and they've learnt to do that, a much better job of that over the years, which we'll come back to when we look at the previous crises, but not a great job. And Turkey is at the top of the list in terms of external debt. So it's the first cab off the rank, if you like, in terms of what is becoming a rolling emerging markets crisis as the US simply outgrows everybody else. And as you can see from this first chart, it's got more external debt than anybody else relative to GDP. A lot of it is unhedged as well, and I think it's also running twin deficits. So it's a prime candidate for an EM crisis. It's no surprise whatsoever that Turkey has been the first domino to fall, if you like. The question that we really need to ask is Turkey large enough to make it to sort of actually disrupt global markets and feed back towards the centre in the US, or not? And if not, who's next? Because the dislocation between US growth and global growth is going to run on for another probably 12 months. The Fed tightening is still locked in, US dollar is still rising, and unless one of these emerging market crises is big enough, it won't flow back into the US growth or inflation enough to prevent the Fed from raising rates, and nor the US dollar from going even higher.
Another structural issue behind that whole so there's a few structural issues behind this rising US dollar. Another one is that a lot of the investors in these emerging markets are often from the US, and when times get turbulent and risky, they tend to pull their money back. And so what you tend to see is that when things are great, there's all these people wanting to lend all this money or invest in all these countries, and then just when they need a bit of support and somebody to be replacing some of the debt is when you start seeing the US investors all starting to pull their money out and pull it back to the US because of the risk. And so that sort of exacerbates these trends as well in terms of, as the US dollar rises, it starts causing problems, which means that then investors start pulling their money out of these emerging markets, which makes the US dollar rise even more, which then turns back into a feedback loop.
You get pro-cyclical kind of effects. So is Turkey big enough? Well, not in raw terms, no. I mean, its largest debt is actually to Spain, and European banks are more on the hook than anybody else. And so, we spent a couple of days in markets worrying about that, but it's not a huge amount of imminent default in Turkey. So in terms of actual sort of raw numbers, it probably isn't big enough to actually disrupt or cause contagion into the global banking sector. The real risk is what do they do in response to the crisis itself. So,
well, and also do other countries start to, because if it flows onto other countries,
yes. Well, we've already got contagion to other countries, but I mean those 2 points are related. Like what the US dollar's starting to suck capital out of everywhere, and
Yes.
and Turkey's making that worse. So we're definitely into some contagion dynamics. It is an emerging markets bear market.
Yeah.
Yep.
And within ones where it turned bad, and we'll move on to some of those a bit later, but the ones that turned bad, like the Asian crisis, the worst countries start, and then you get a couple of the other ones, and if contagion spreads wide enough, then some of the countries that are actually not too bad end up getting sucked into the whole
right.
mess, because it's just that we're clearing money out of Asia or emerging markets or wherever it is, and you
that's right, and you get a generalised panic. So, I mean, for me, probably the key moment for Turkey is if they panic and install capital controls to prevent the lira from crashing and their debt getting ever more expensive, etc. If they impose capital controls, then we might actually see things get a lot worse, because that sets a precedent for other emerging markets, and suddenly all of the capital sitting in emerging markets that is freaking out about its exposure to this developing crisis realises it can't get its money out, or may not be able to get its money out at the worst possible moment, and so they all run for the exit at once.
And that's part of that. Reading off this chart, it's if you're investing in Hungary and you're sort of sitting there going, well, Hungary's not too bad at the moment, but I think everything's, I think I'll make it through. And then next thing you know, Turkey puts capital controls on, and you're sitting there going, well, just a minute, I better get my money out of Hungary before Hungary follows suit. And so then you that's where the contagion.
Yeah, exactly right. So. So if you want to pop to the next chart, where is contagion going to run next? It's been hitting worldwide, Latin American currencies and Asian currencies, as well as a sort of hodgepodge of other emerging markets from just about everywhere. The question is, we didn't put that other chart in. Okay. Who is most vulnerable next? South Africa doesn't look very good.
Okay.
It's got twin deficits and a reasonable amount of external debt. Ukraine looks really shaky.
Right.
And then, there's a whole swag of them that are sort of second level risk, where they're not in bad shape. They've got some forex reserves, which allows them to sort of defend their currency a bit. And their deficits aren't bad, nor is their foreign debt all that huge. But they've all got, they're all in this basket that could come undone. So it's really, I think South Africa is in trouble. Brazil may be in trouble as well. It also has, some of the characteristics that we're talking about. And you might note as well, just in passing at this point, we'll come back to it, that all of these nations are actually commodity producers and exporters as well as big commodity consumers as developing markets. And so this is how the emerging market crisis tends to suck in commodities at the same time as well. There's a whole range of reasons for that, but that's certainly one of them. So looking at this next chart we've got here, this is the rise of US dollar denominated debt in the emerging world over the last few years. And as you can see, the vast bulk of it is actually in Asia. And there's a huge chunk of it in China, which actually in terms of its GDP is relatively small. It's about $500 billion. There may be some more floating around there that isn't so easily found. I've seen reports up to double that amount if you fold in all sorts of portfolio holdings and other wacky stuff. And so China, China's certainly not at risk up front, but the longer the crisis runs and the further the yuan falls, a lot of that debt is particularly concentrated in the Chinese property sector, and so there is some risk that interest rates will tighten overly there in that segment, and so that's a risk to commodity prices. That said, at the moment their property market's running off to the races again, so it doesn't look like that's a huge imminent danger. But again, you'll see there is this huge pile of this US dollar debt in Asia. However, because of the Asian financial crisis many years ago, most of these Asian countries manage this quite well these days. And so even though there's a lot of US denominated debt,
and when Dave says a lot, for anyone who can't see the chart, there's about $2 trillion in Asia, but excluding China.
Yeah, so effectively two-thirds.
Yeah, and you add China and you're probably at 3/4.
Yep.
Most Asian countries are running current account surpluses. Many have got budget surpluses as well, and so they're actually just a lot less vulnerable than they were 20 years ago or even 5 years ago.
Right.
Now that may sound encouraging, and it is. It's not obvious where the next domino will be, and given Australian exposure to Asia, it's good that it's not obviously there. Nonetheless, what that means is how much of the crisis blows back to the US. If the crisis is really just a symptom of a strong US, a decoupling strong US, and rising US interest rates, then the rest of the world, if the emerging world or large parts of it can hold on through this, and some vulnerable dominoes fall, but by and large survive it.
Yep.
Then US interest rates and the US dollar keep going up. At least until such a point when, either something feeds back into the US to damage its growth, or the US boom itself just peters out. You can't necessarily, in some ways, the fact that these countries are better positioned may only mean that the crisis has to run further before they're found out. But there's no way of knowing which way that's going to go at this point.
And when you're saying that, so there's two sort of paths we're looking at. Primarily, one is that this is the first domino, and then maybe South Africa or Hungary or Brazil, dominoes start to fall, and the next thing you know, you've got a full blown emerging markets crisis. And the other side is you get something similar to, say, when Argentina defaulted or something. So it's a single country that has problems, and maybe there's a couple others that have their debt repriced, but US is growing pretty strongly at the moment, and the world just sort of sails through and waits for the next sort of event. So really it's trying to work out, is this the start of a major crisis like the Asian crisis, where the first domino knocked over a few other vulnerable ones, and next thing sort of middling countries are being knocked over, or
Yep.
is this
So if we move on to the next chart there, we'll take a look at I guess what is the few major forces that are now in play to push the crisis further versus what's now being done to try and head it off, and either mitigate it or prevent it from getting worse as soon as possible. So we've got, as we've discussed, this rising US dollar, this capital outflow from EMs, the beginnings of contagion, a few dominoes falling, but by and large emerging markets okay. Now you overlay that with a trade war, which is also making the rising US dollar worse, or better or worse from whichever perspective you want.
It's also seeing the US dollar rise further.
Yes, it is, because tariffs are pushing up US inflation. That's pretty straightforward.
Mm-hmm.
Now the US boom is very fiscally generated. That is, a lot of it's come out of the tax cuts. The US generally grows these days at about 2% as a natural rate of growth, but the tax cuts have boosted that above 3%. That fiscal impulse won't be really reversed properly for about a year, and so you could say that you've got that long for this crisis to potentially get worse, but at the same time for the world to ignore it and keep growing. Now the trade war, as that comes in and raises interest rates in the US and lifts the US dollar, it's just an exacerbating factor on top of that. The falling yuan is similar. We also happen to have China in the middle of a financial sector adjustment where they're trying to move away from shadow banking. That's slowed their economy, and so the yuan is falling also because the Chinese economy is slowing. So you've got all of these things: a rising US, a slowing China, a trade war that could make potentially both of them worse. And that's also started to generate a response in China, especially where we're seeing stimulus. Quite a lot of it, but not a huge amount yet. But they've started to shred their interest rates, at least money market interest rates. There's a move towards fiscal stimulus as well. As I've already mentioned, their housing market's still going quite strongly. That said, their momentum is down, so we don't expect them to get traction until probably Q2 next year, or even mid next year, to get a growth response out of the stimulus that's starting to roll. So potentially, you see all these complications starting to come together yet next year, when you've got what is still a developing emerging markets crisis, but potentially a slowdown in the US as that fiscal impulse starts to reverse, and a rising China next year. So, one potential kind of outcome of the current array of influences is that you get pretty much a reversal of the current drivers, where the US starts to slow, the Fed either pauses or stops raising interest rates, the US dollar stops, and China rises again. Now that's a replay of what happened in 2015, where we had a dry run on this crisis. We've had a couple of dry runs. We had the taper tantrum, and then we had the 2015 mining crisis, and now we're here again. So
when you say dry run, though, markets were down sort of almost 20%. So it was certainly it wasn't a full blown crisis, and we're not certainly nowhere near a full blown crisis at the moment. But it was certainly enough to
dry run in terms of the dynamics.
Yeah, that's right.
Yeah.
But it's certainly enough to change your investment positioning and things like that. To see markets, when markets are falling 20%.
That's right.
You're going to be switching in and out.
Yep. So if you want to just shift forward again there, Tim, to another couple of charts. What have we got? This one's China stimulus, basically just a picture of what they've done with lowering interest rates in their money markets. They haven't done it with the cash rate. If they did, I think the yuan would really be in trouble, but I don't think they're necessarily going to have to, as I said, because I think they've got enough growth momentum to kind of pull through.
Right.
And so what this chart's showing is that the Shanghai interbank rates were sort of up around close to 3%, and they've precipitously fallen. Now they're sort of in the low twos, sort of close to 2.2.
Yeah, and all the way back to where we were in 2015, when China was in something of a hard landing crisis. Just want to pop forward again. I think maybe we'll kick forward to the previous crises, because that's kind of where this discussion's going.
Okay, sure thing. Yep.
So we've kind of looked at the broad outlines of the emerging markets crisis. We've looked at the broad outlines of possible solutions with a slowing US and a rising China in 2019. To try and put those things in context and see what history can tell us about the most likely outcome, we thought we'd also run through the previous crises that have actually had very similar dynamics and see what that can tell us. So, I mean, the first one we've got to look at was the LATAM crisis that was a part of the. It basically came out of the oil boom of the 70s, where during the so-called energy shock, oil went to the moon, and then a whole lot of very rich emerging markets with oil recycled all their gains into US banks, and those US banks had to put it somewhere, so they lent it to Latin America. And then the Fed, as that cycle sort of wound up or got more heated, the Fed had to raise rates, and a lot of that capital got repatriated, and we had a classic kind of case of emerging markets crisis there, where they all crashed as a result.
And it was sort of similar in the dynamics in that, in that it sort of centered initially on Mexico, where they basically the realization came that, hey, these guys can't pay their debts, and so that sort of meant to a capital outflow from there that then dominoed through the rest of that whole area, in terms of, well, if this can happen to Mexico, maybe it can happen to Argentina or Brazil, or a whole host of other Latin American countries that sort of went through that same process. And some of them weren't actually on their own, probably didn't deserve to have what happened to them, but at the time, people who they'd been given these debts, and then when the time came to roll over the debts, it was basically no, we're not lending you the money anymore. We're taking it all back, and so that sort of helped to do it. And it's worth noting as well, the interest rates were obviously a lot different at that stage. We're sort of talking about 19% interest rates in the US, and then drop once the crisis hit, sort of pulling it back to sort of around about 10% to throw stimulus at the market and help them through.
And I guess that's an interesting point, in the sense that, looking at obviously crisis in general and what causes it, and there's some commonalities there, but at the same time, from a market and a funding and a just general financial availability and interest rate point of view, it's obviously certainly a fair bit different to that. You're mentioning 10% versus now negative percent in some countries.
Well, when you get, and the market, markets fell 20%, but having the ability for the Fed to drop rates from 19% back to about 10%, there's obviously a fair bit of stimulus that sort of lets loose on the economy in terms of so there's certainly much less scope at the moment for them to throw things, but they've obviously got a lot of innovative ways to get money out into the at least into the banks.
Yep.
Maybe not into the rest of the economy, and I guess that's certainly a common thread between a lot of these, is that you get a crisis happen, the markets really take a hit, and then the Fed goes, okay, we better come in to help out this one and start spending. Now they have said, Powell said that he's not going to do that. That's not his. They're not there to
be the saviour,
to shortstop markets. But if the markets took a tumble and 20 something percent, and the concerns are out there, then we'll see how true that statement actually is.
Yeah,
sure.
Well, I mean, if we run through these other crises, I think you start to get a sense of what will the Fed reaction function be. I mean, if we look at the Asian crisis in 1997, which again was a case of US dollar debt inflating the Asian tigers, a lot of the small economies, and they were all running big current account deficits, growing really fast, and then the Fed starts raising interest rates, and it was the early days of the dot-com boom as well in the US economy. It was growing like crazy, and its budget had never been in better shape. And so the US dollar started going through the roof and just started blowing up these economies that had external US dollar debt one after another.
And that sort of kicked off with Thailand, where Thailand was sort of pegged to the US dollar. And so again, growing quite strongly, but just so much strength in the US economy that the bet basically came out that Thailand can't maintain that peg, and traders traded against it until they were right.
Yeah.
And then that sort of spread to many other countries.
It did, and that was of sufficient magnitude that it pulled down Wall Street. So that's obviously one of the key reaction functions for the Fed. Wall Street fell, I think, roughly 25% in the Asian crisis. And eventually the Fed cut 4 times to head it off. Now in there we also had long-term capital management.
Yeah, so I mean this is the bits about dominoes you don't know. So one of the effects was that we had the Asian crisis sort of then meant that the oil price really got smashed as well, and it sort of fell down to I think about $11 it bottomed out at, which then caused a problem in Russia and debts in Russia as well, and which sucked in this long-term capital management, which was a US hedge fund, which had made some massive bets in the US on various sort of relatively safe strategy, you'd say, in a longer term sense, in that they were sort of playing up and down on the bond yield curves about saying, well, if I can take a 5-year bond and go short that and long the 6-year bond or whatever it is, and mixing and matching, so that they're basically just playing around those durations, but doing it with lots and lots of leverage and lots of and in such massive amounts that then when these crises hit and they lost some money on some Russian things, then they couldn't afford to fund some of these positions, and these positions which were again were sort of long one part of the bond curve and short the other part of the bond curve. So in the end, you're probably relatively limited as to how much money you could lose. But the fact that you used so much leverage and they lost their ability to fund the positions and all that type of stuff all of a sudden turned this into a massive issue. And I guess it's a long-winded way of getting to the point of saying when there's lots of debt bouncing around in economies and something goes wrong in one area, it can show up, and we sort of titled this the butterfly effects, can show up somewhere completely different that nobody ever expected. And the point of that is coming back, to drawing back to the current example, is there is a lot of debt still sloshing around, and there are some we're 10 years on from the last financial crisis, so there's a new breed of traders and people who are willing to package things up. And
short memories,
that's right. And so quite possibly there are other issues that will pop up that you can't prepare for or know about, because you just don't know how much leverage somebody's got in underlying positions in particular markets, and maybe it's a commodity market that lots of leverage into the gold market, and next thing you know the gold price has fallen, and all of a sudden there's leverage plays in that, or
that's right. And I mean with long-term capital management, this is also segues with the Fed's reaction function, because it was threatening to wipe out a whole bunch of US bank capital in its losses. And so there's a line of contagion that was going directly back to the heart of the US economy. And so that's what really got the Fed off its chair.
Yeah, and so it wasn't just the rate cuts; it was them pulling 6 different banks into a room and saying, "You guys are going to sort this out."
Okay. No, that's and I guess then drawing that to today though, where we've got a tightening sort of situation in the US. The effect of sort of something like this happening, where they've got there's rising inflation, all these sort of indicators that we need to get you should probably be tightening, and then this EM problem that's arising could potentially
there just isn't yet a channel of contagion into the US.
Okay.
There isn't one, so the Fed's going to keep going for now. And as we say, we'll get these random dominoes unless we get some butterfly effect somewhere, a long-term capital management that's made a really wild bet that's just out of the money suddenly because of these, it's huge volatility we're talking about. And so that takes us into the 2015 crisis, which pulled the US stock market down about 15%, something like that.
Yep.
And that was not enough for the Fed to intervene, but it was enough for it to pause its tightening. Janet Yellen, very, very explicitly and actively said, "I'm going to pause," in early 2015. And the reason why, then, when we had very similar dynamics going on, we had a falling yuan, we had falling emerging markets, we had a rising US dollar, we had all the same dynamics in play. The reason the US stock market, was sucked into it was commodity prices, and particularly oil. Because oil, the US is now the world's largest oil producer. It's become a very key component of two things: both its wage rises, but also just its supply side growth. Like, it's a very big driver now of US growth. And so when we saw the huge oil crash, I think we went from 110 to about 26. It was an epic. The whole US shale oil industry just was in outright crisis. At that point, a lot of it was debt funded, like floating debt, junk bonds, high yield bonds, and so we had this toxic combination of a Chinese kind of slowing and hard landing, falling yuan, falling emerging markets, falling commodities, and then suddenly in the US a choking up junk bond market, and that sucked down the S&P 500, and so that was enough to trigger a reaction function from the Fed, which, as we said, was to just not tighten for a while. It happened to get together with the PBOC, the People's Bank of China, at the same time, I think in Shanghai, and what's roughly known as the Shanghai Accord was struck, which is nothing official. It's just a sort of vague notion that they all got together and agreed that the Chinese would stimulate, and the US would ease off tightening, and that reversed the entire crisis very quickly. And we went from mad capital outflow from emerging markets, including China, to mad capital inflow, which ran until today, or until probably about 3 months ago when the crisis basically resumed. So,
I wouldn't say crisis resumed, but I certainly say that when
the dynamics returned.
The dynamics returned. Yeah, that's right.
So that tells you, or gives you a hint on one potential element of contagion that could again stop the Fed, and that is if commodity price falls, which they're all getting caned at the moment, but if that really gets moving and growth worries infect global markets such that oil crashes, then you would definitely be into territory where the Fed would be looking at slowing its tightening. There are a few people around that are already mulling the Fed stopping its quantitative tightening, that is, stopping it running off its balance sheet of bonds and debt, which is a separate question to actually raising interest rates. So the markets are already sort of mulling when the Fed will be forced to slow its tightening. But as said, we think there's still another 12 months of good growth there. Profits are insane in the US at the moment, thanks to Trump's stimulus. And then you've got another added complication of, will Trump just allow his fiscal stimulus to slow, which it will within sort of 12 months or so, or will he put on more? He's got midterm elections at the end of this year. That's also a political consideration, and there's a pledge to push $1 trillion infrastructure in the US that he would no doubt like to meet at some point. It's been a bit stalled, but it's the kind of thing the Dems would love to sign off on. And so that's potentially another 0.5, even 1% growth you can add to the US for 5 years if you can get that kind of baby up and running. So that would then change the calculus for the Fed as well, because you've got a whole lot new kind of growth and inflationary kind of impulse coming through on top of the trade war, and et cetera, et cetera. So it's not, at this point, it's not easy at all to know what either the Fed reaction function is or when it will reverse course.
Sure thing. And I guess then, moving into our final point there, but how we've got here different to the world's favourite financial crisis of late, the global financial crisis. So, what's I guess based on the previous three examples there, where are we looking, or why is the global financial crisis different to what we're looking at today?
It's actually, I wrote that different to GFC. It's actually not all that different. But it's not different in the sense that the Fed causes all crises, really, global crises. I can't remember a global accident or recession that hasn't come out of Fed tightening.
Yep.
They nearly all do. So in that sense, it's very similar. They're all the same, but
you had a weak US is a big difference.
Well,
you did, but it was the US had a rampaging housing bubble. Does the US have asset bubbles now? Look, shares are very expensive, but at the same time, their growth is pretty unique worldwide. The profits growth is absolutely off the chart, and so it's difficult to call that a bubble either. It's certainly highly valued or fully valued, but it's difficult to call it a bubble. Could you call the Nasdaq a bubble? Not in your grandfather's terms, no. Damo, what Apple's trading on forward earnings of 14?
Yeah, 15, but
15.
Yeah, Google's sub 20.
Facebook's on 24.
Yeah.
These are not multiples that would terrify anyone who was in the Nasdaq in the 2000s. These are very reasonable valuations for companies, very high quality companies with very high earnings growth.
So I guess essentially the bottom line is that the GFC being principally a US-led global recession as opposed to these more fringe sort of emerging market sum of parts potential crises.
Yeah, I think that's fair to say.
Yep. Okay, very good. We better jump on, just in terms of interest of time there. We've had a look there we've probably run through most of these resolutions.
We have, yep.
Actually, it is worth noting as well, though, we've picked a few crises out that are similar. There's been plenty of other crises, whether it be something like Argentina defaulting or a whole range of other countries that have defaulted on debts and not caused worldwide contagion. So even if Turkey gets worse and turns into a basket case and needs IMF bailouts and things like that, that doesn't necessarily mean that you'll then get a 20% fall in the US market and the Fed needing to step in and change its things. There are plenty of cases where contagion doesn't happen as well.
So essentially there's some steps of isolation that can be done.
So in terms of the paths, it's not just it's not it's
one in, all in.
Yeah, that's right. We need to work out how likely are these dominoes to fall. That's the key part.
Yeah.
Okay, sure thing.
So that's where we're trying to get to. This next bit is what are the danger signs? So what can you look for, or what are we looking at in some of our key ones?
And the first one here we've got is a junk debt.
Well, this is the key chart.
Corporate bonds.
Really, that I think it's just the ultimate litmus paper for whether this thing gets better or worse. You can see those two lines. One of them, the lower line, the purple one, is an emerging markets index for high yield debt. That's high risk corporate bonds, sometimes called junk debt. And so because that's high yield and high risk, it's like kind of a first in, first out market.
Yep.
When things are good and everyone wants to get higher returns, they all race into this stuff.
Yep.
You call it the dash for trash. and when things get bad, it's the first thing to go to pieces, because this is where the defaults will be. So you can see the other line is the US junk bond market. So that's the green and red one. So you can see that they typically track one another relatively closely, at least in terms of trend, not necessarily in magnitude, but definitely trend. Until today, where right now you can see that the US junk bond market is stable. That's on the far right edge there. It's just going sideways, whereas the emerging market junk bond index is absolutely crashing. Now that's the decoupling that we've got right now in the global economy. So you want to watch how these two lines interact. Basically, it will tell you what's coming next. The junk debt for emerging markets is still falling out of bed. That means emerging market equity is going to follow. So at minimum, we're going to see more downside for stock markets in emerging markets.
Yeah, but it's also worth noting that in your 2015 version, is that you got the divergence as well in that period, where the emerging markets got trashed. The US was actually rising at that time, or certainly sideways, and then until
you did, although I wouldn't necessarily say that was true in trend. To some extent, but
I guess what I'm saying is you had a period of 3 or 4 months where they diverged from each other.
Yeah.
Before it was, the realization came that, hey, the oil price has fallen.
Yeah.
All these companies have also got problems.
Yes.
Because I think the initial phase was, China's got problems. Everyone's talked about it for years and years and years. Eventually, here they come. Finally, the chickens are coming home to roost. It's China's problem. We'll be fine. Yeah. And then it was, oh wow, the oil price has really been smashed. Just a minute, our high yield market's full of these companies that have borrowed for shale oil wells. Maybe they're at risk as well. And then that's the sort of the.
The key for investors is to realise that typically equity follows credit, and this is your most sensitive credit market to all of these dynamics that we're discussing. So as long as US junk credit or junk bonds are okay, if that market's solid, then the US stock market's going to be fine.
Okay.
It's not until you see a recoupling of those two lines that US equity is really in any kind of peril. But while the emerging markets index falls, you're definitely going to see emerging market equities in trouble, which is what we've already seen with basically the S&P and NASDAQ at record highs, but emerging markets, stock markets taking a real pounding along with the Forex.
And so I guess this is one of the key indicators that's a bit of a watch this space for you guys on the investment team.
This is absolutely a key chart, absolutely.
Yep.
And you can see relative to 2015, we're starting to get to pretty deep levels of distress for emerging markets.
Yep.
That's not to say that it can't go much deeper. It can. It certainly did during the GFC, etc. But this is the one I follow as the leading indicator for the whole thing.
Okay, very good.
Yeah, so other danger signs I guess we're keeping an eye on. We spoke about earlier the capital controls in Turkey. Not so much because we think the capital controls in themselves will do harm. It's more that other countries, investors in other countries will work out whether they want to start pulling money earlier.
Yep.
Then tracking some of those other countries as well that are the higher risk ones, because if you get enough dominoes starting to fall, then all of a sudden it turns into a large crisis.
Yeah.
Okay.
So and oil is the other one.
Yep.
Like simply as a replay of the 2015 semi-crisis. If growth worries about emerging markets, which now constitute 50% of the global economy and something like 3/4 of global growth, if those growth worries really intensify and commodities get sucked down and oil with them, then the US is in it.
Sure. And I guess just quickly, so obviously the investment landscape for us being the MSCI World Index, or the largest 1,700 companies in the world, where would emerging markets will obviously sit a lot out of that space on the whole, or is it sort of something that on the fringe edges of the MSCI world that's outside of the extra contagion obviously issue, but just the immediate issue? Is that something that plays into when you're researching a company or you're doing the analysis or exposure to these markets?
Absolutely, in terms of which countries countries have operations in. So, for example, European banks, which we're largely out of European banks at the moment. The first bit was, okay, which of these are the ones that are most exposed to Turkey in terms of which ones have lent to Turkey? So it's those thoughts in terms of, have you got operations in those countries? If companies have, if they're not exposed to the demand side, if they've got production facilities in those countries and the currencies are tumbling out of bed, well, that's a good thing for your cost of production is going down. Yep. So for it really depends upon are you dependent upon supply in those countries or are you dependent upon demand? Okay. And then what are the various dynamics in terms of that? And I think
So in terms of how we're thinking about this, for investment purposes, we basically use scenario analysis. We don't know where we are. We know we're late cycle for the globe, but we don't know how late. 3 years to go could be late, or 6 months. And so there's a lot of returns potentially still there, and you don't want to be hiding when those returns are still available. So, at the same time,
scenario on the upfront before we get into the negative side, the scenario on the upfront is on the upside is that China starts to spend a lot of money. Yep. In terms of stimulus, which it certainly appears to be doing, and maybe it puts on a bunch more in terms of infrastructure. You get Turkey's relatively isolated; doesn't spread to other countries. US, puts in a big stimulus package in terms of in terms of infrastructure to carry them, so they've got sort of another 6 or 12 months worth of growth just from the existing ones. Then the infrastructure kicks in, and there's another year or two of growth from that. Yep. Meanwhile, China's busily, they're in a trade war, and China's busily spending away, building new cities and knocking down old ones type thing to get that going. There's quite a bullish story you can pull out of that if you don't have a crisis.
Oddly enough. Very commodities bullish as well.
Yeah, of course.
Because it's all building centric. So there is that potential kind of bullish outcome and narrative, and then of course there's all of the things that we've discussed today as possible downsides. So, like what we've done, and if I may say so, this is going exactly how we forecast it, like a year ago. When we defined it as something called reverse decoupling, which was basically the idea that the US was going to outperform all of the emerging markets through the next kind of 12 to 18 months, which is late cycle, versus what happened in 2007-8 when there was this notion of decoupling of emerging markets from a failing US.
Sure.
So it was an inversion over the two cycles, and that's played out exactly as planned. So, we're positioned in a way where we've got quite conservative equity exposures, but we're in all the right spots to maximise the return, and so we've got good hedge in having limited equities exposure. We're at what, 70% versus 90% max, or even less, or
a little bit less than that.
65,
66.
65, 66.
And that's in our growth option that's meant to have 90%.
That's what we use as a sort of benchmark to discuss it. And then, the other component of this whole thesis was that the US is not exposed to emerging markets, but Australia is. So being offshore right now is great because the Australian dollar and commodities are going to get sucked into the emerging markets part of the global story rather than the US boom story. So that gives you a double boom.
Yep.
You get both terrific profits growth in the US and a falling Australian dollar. So that's played out really well. And given the balance of risks and rewards that we see in this late cycle period, we're still kind of sitting with that balance.
Yep.
We've wound it back, but we're not So when a year ago we were a lot more overweight international.
Yep.
We're not underweight international, but we've just been chipping away as markets have been rising and just pulling that back and pulling it back, and it's trying to walk this tightrope of saying, well, we are worried about the downside risks and seeing how big they are, but also we're recognising that there's plenty of upside, that if the downside doesn't occur, that there's plenty more upside to get from these markets.
And I think that makes sense.
Yeah, I mean, policymakers have become very adept at kicking the can worldwide.
That's right.
And so you have to be aware of their power, like to reverse quickly and turn what is a crisis into the next opportunity.
Good, well put. Got a quick question here, actually. So obviously this is, broadly speaking, what the professional management sort of do. I've got a question here from one of our viewers saying, if this is a new financial crisis coming, what can normal mum and dads who are non-investors, who work for a living and have a mortgage debt, do to prepare? So
Don't lock in your rate.
Don't lock in your rate. Oh, very good. Okay.
I'm actually going to disagree with you there.
I think you should lock in your
rates
rate.
to the moon.
No, because look, it's not that the RBA won't try to deliver some easing. They will. I mean, if this goes badly, and we get an emerging markets crisis that results in a global recession one way or another, that will be very bad for commodity prices and be quite tough on Australia. But the RBA, even though it will cut, it's only got sort of two cuts left, maybe three. It obviously at the Australian cash rate at 1.5, it looks like it has more, but it's already said it doesn't want to go below one-ish because I think it's very afraid of turning itself into an emerging market with no rates uplift from elsewhere, meaning the Australian dollar collapses. And so, with the banks already facing rising funding costs, in part owing to rising funding costs coming from all of the things we've discussed today offshore, the banks are going to keep at least half of that. And so that gives you one rate cut's relief, and we're at the bottom.
Okay.
I'll respectfully disagree. I think there's. I think I think that's what the banks said. That's what they've said. But I think if that scenario played out, they would have to go below 1%, and they would have to put more. Like, there's not much more. It's not going to make a huge difference.
Even if they go to 0.5.
But there's another 50. Yeah. So what we're saying I guess what I'm saying is, yeah, you can get another 25, maybe 50. Probably get maybe 50, maybe even 75 if they're really pushing the envelope. But anyway, there's something more there. I guess from a if you're not an investor though, subject to trying to changing your job to something that's not going to get where you don't lose your job if crisis emerges, which is a pretty big call for an uncertain future, then there's really not that much you can do as a non-investor.
Well, pay down your mortgage as best you can.
That makes sense.
Yeah.
Reduce debt.
Yeah.
And enjoy life. Okay.
Well, I mean, it gives you a much better return than a term deposit.
Yeah.
So
after tax. Fantastic. Okay, very good. All right, thanks for that. No other questions at this time. So on that note, thanks very much, gentlemen. And if you'd like to find out more about how to get the power of, the discussion we've had today, I was about to say the emerging markets, but we're going to say we're going to steer clear of those for now.
Yeah, we've absolutely. We do have the scope to buy some ETFs in terms of emerging markets, but it's just one of those things we haven't been interested at all in over the last year.
And I guess given the relative strength of the US and the opportunities there, it makes sense to be in that safer side of the investment world for the time being.
Yeah, absolutely. We're not looking to put on any emerging market trades at the moment.
No.
Fantastic. Okay, so we'll jump into some information about Nucleus Wealth. Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment. To ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com. Okay, so if you enjoyed that one, you'll love the next one. So coming up next week, same bat time, same bat channel, Thursday the 23rd of August at 12:30, we're doing our deep dive into a conservative investor. So if what you've heard today is a bit of a worry, or if you're just worried about, I guess, beating the term deposit, which is of course at all-time lows at the moment, be sure to tune in to see how we can put together, how we do put together portfolios for clients that are always erring a little bit on the safer side, and how we view defensive investments in our portfolios. If you'd like to check out that one, head over to proton.nucleuswealth.com and register your interest. As always, we are also available on iTunes and Podcast Addict, or wherever you get your quality investment podcasts from in the Android space. Quick one too, actually, if you do like what you hear, please feel free to put through a review or give us a like or 5 stars, or however you can show your gratitude in those. It does help us just get out into the community a little bit more and build our listener base. So that'd be great. And also, as always, we can send through our survey. We've actually made up a site as well, giving you access to the site as well, which is bit.ly/Nucleus survey. If you go to that web address, then it will take you to our survey, which gives you the opportunity to rate how we've gone today, and of course drop in any further topics that you might like to hear about. So feel free to head there. You can also send us an email at webinar@nucleuswealth.com if you've got any topics or anything you'd like to put in through there as well. So on that note, I thank you very much for your attendance today. I hope you got something out of it. I certainly did, and we'll look forward to catching you at the next one. Cheers.